If you want to trade this market, you'll get killed. It's as simple as that. Because they're far cleverer people than you with big, big, deep pockets who will push things around. And, if they reckon you're in there, they'll kill you. So really, I think you've got to take, if you like, a more sensible view as to actually why it is that you own gold or silver. And the only justification for that.
On this episode, I'm thrilled to welcome Alasdair Macleod to the program, a 40-year veteran of the finance industry, an expert in precious metals, and the author of the Macleod Finance Substack. Alasdair thinks the recent drawdown in gold and silver was nothing but a blip on the radar, arguing that the continued destruction of purchasing power in fiat currency terms and the rapidly growing credit bubble will send prices for both metals much higher. Up ahead, Alasdair breaks down where he thinks we are in the credit cycle and when this monster bubble, one that he says is the biggest in history, will finally burst. We also dive into silver shortages at the LBMA, the death of American hegemony, and so much more. So strap yourselves in for my conversation with Alasdair Macleod.
Because they are at a premium price is because they are money. They are legal money. They are final settlement without counterparty, counterparty, as opposed to credit, which is what a fiat currency is. And if you reckon that the situation for fiat currencies is deteriorating, then that's the reason to hold on to gold. And, whether it sort of goes up 5%, falls 5%, is completely immaterial. The thing to bear in mind is that the value of gold is relatively constant over long periods of time. It is the value of fiat currency which alters, and that has been declining very significantly, particularly since 1971, when the Bretton Woods Agreement was abandoned. So in dollar terms, you had $35, that was the official rate, $35 to the ounce, and we're now looking at nearly 4,150. I mean, that tells you basically that a 1971 dollar, or rather the dollar today, is less than 1% in its value of the 1971 dollar. And that's what you've got to keep bearing in mind. It's not a situation that is going to change in favor of fiat currencies, that's for sure. Politically, it would be impossible for any government, in the G7 anyway, to reverse the decline in their currencies. They've been educated, I think, by the macroeconomic establishment, which really started with John Maynard Keynes, to, if you like, use a weak currency to benefit the economy, to stimulate the economy. They're not going to change for that, particularly when freed from the constraints of the gold standard, that they can issue as much debt as they want. And that's what they're doing. So you've got an accumulation of debt, and that's where the crisis now is. What's going to happen to the value of that debt? The other side of that debt is the value of the currency. Debt equals credit. Credit is the currency, and also loans underneath that, which businesses have taken out, individuals have taken out, stock market speculators have taken out. It's the value of that credit, which you've got to question. You've got to keep your eye on that. So, short answer to your question is that stackers should maybe say, well, thank goodness we've got a sort of situation which means I can, save a bit more out of useless credit and put it into real money. Let's hope this pause goes on for some time, and then I can really sort myself out. I think that's the way to look at it, not to be spooked by what's going on, if you like, in up 5%, down 5%, whatever. Well, yes, I would think it is. Now, in terms of timing, that's up to the individuals. But basically, mines are a leveraged bet on the commodities that they produce. And if you see the value of gold expressed in fiat currencies rising, so long as energy prices don't rise more quickly, that's going to be good for mines. I mean, you've got to look at the input cost side as well. And also bear in mind that most producing mines, they will be managed through this. So what that means is that they will extract lower grades while they are profitable, rather than the higher grades. So the idea that you can translate immediately a higher gold price into higher profits, I think you've got to temper it a little bit and just understand the reality of it. The other thing I would say is that gold is hardly owned. It's less than 0.5% of all portfolios, if you like. Mines, on the other hand, I think are a bit more owned. And what I'm looking at is, this is a credit bubble. Obviously, if you've got a debt bubble, which we have, the other side of that is credit. And more importantly, this credit has been applied to inflating financial assets. particularly stocks. Now, all credit bubbles come to an end. They pop, and when they burst, they usually burst quite spectacularly. 1929, October. 1987, October. October doesn't seem to be a very good month. I'm not saying that this October is going to be the crash, because we'll look back at it and see whether that's true or not. But when the bubble implodes, basically what people do is they will sell anything where they've got a profit in order to cover the things where they've got a loss. So that's the only caveat I would really have, I think, on investing in mines. But other than that, it's you can regard it, if you know what you're doing, as a leveraged bet on the underlying commodity. In the case of gold mines, it could be a way of you catching up if you want to speculate a bit as to the route to do it. But your core holding always must be the metal, because that is the one thing where there is no counterparty risk. No doubt there's been a huge rate squeeze. I mean, you can see this in lease rates, and basically, someone who's got an obligation to deliver physical metal tomorrow, and if he hasn't got it, he's got to go and lease it from somewhere. The lease rates have shot up. I mean, typically they were sort of up to 30, 40%. And there's some reports of them going up to 100% and more, basically saying, there's no more left to lease. The other thing, of course, is that we see a backwardation, which by definition is when the spot price is above the futures price. And people got very excited with that being over $3 at one stage, which, of course, would prompt arbitrage. I mean, people with silver sitting in COMEX warehouses would think, okay, we'll ship some of that over and make on the arbitrage. So there've been lots of stories about that. Now, how true they are or whatever, I honestly don't know. I'm sure there's a bit of it, but it's probably exaggerated. What I would say is that the backwardation of spot over futures has actually declined now to around about $1. So it's come way, way down. It still indicates that there is a shortage. In other words, a squeeze on those who are short. Because the problem is that the vast majority of the silver in the LBMA bulls is ETF silver. And the other thing which puts additional pressure on the system is, of course, people look at silver, they see silver going up, they probably think they've missed gold, and therefore the silver is a cheap way in. So they run out and buy ETFs. ETFs have to source the metal. And I think it was last week we heard that a number of ETFs, silver ETFs in India, suspended share creation because they couldn't source the silver. And I think on that basis, I mean, really what we see is that silver is too cheap for these deteriorating monetary conditions. That is absolutely clear. It is therefore going higher. But the question is, you have to ask yourself, I mean, as the price rises, what are people going to do? Are they going to just take profits? Or are they going to say, I'm going to hang on to my silver because things are not looking so good for the fiat currencies, for the dollar, whatever. Gold is going up. Gold-silver ratio currently 84, should be below that. Why should I sell my silver? So I think it's a situation which actually, particularly through the growth of ETFs, a rising price could lead to further demand and less supply, because the supply always has been from weak holders in the paper markets. So I think, Jesse, this is a fascinating situation. It's what they call a Giffen good, something which reverses the normal supply and demand relationships on price. I think what you have to do, when it comes to where you store your metal, and whether it's Canadian Royal Mint or whatever, is to take a view on the property rights of that country. How firm are they? Are they likely to be overturned, if you like? Now, I mean, it's an interesting point. I've had arguments with people about what happened in 1933 when, you had the executive order, and basically it wasn't a gold confiscation. People say it was a gold confiscation. No, it wasn't. It was a forced submission, if you like, of your dollars for gold at that time at $20.67 to the ounce. So, if you actually had gold, and it was the banks, basically, if you had it in the banks obeyed the government. So, you lost it. On the other hand, if you had it yourself, then you just kept quiet. But it was really when it goes in the system. And if they turn around and do something like that, then you're going to lose it. The difference today is that you have, in America, there is an official gold exchange rate at $42.22 to the ounce. Now, you have to ask yourself the question, would the Americans force the banks to take your gold and gold under in their custody and all the rest of it, and exchange it for $42.22 to the ounce, where the market price is 4,100 or even more? I don't know the answer to that question. There may be a legal way in which they could do it. So what I would say is you don't store your gold in America, and you don't store it in a vault owned by an American corporation. And that could be in a vault abroad. So I'd say that. I think the Royal Canadian Mint, I would be less worried about, because Canada has some very strong property laws when it comes to property rights. I feel the same in the UK. The same is true in Switzerland. I think the other thing is that there is a big difference between banks who are regulated, and they may well be, I don't know, the regulator, through regulation, if you like, there may be a bit of a danger there. But I think by far the biggest danger with ETFs is that actually, when you own shares or stock in an ETF, it's credit. You do not possess the metal. You do not even have an entitlement to the metal. All you have is an obligation by the manager of the ETF to perform his duties on behalf of you as a shareholder. He's got the obligation, and you've got the credit, if you like, the other side of that obligation. But then it gets more complicated, because you don't have a direct relationship, usually, with the manager of an ETF. The manager of the ETF sees as his shareholder either the DTCC or Euroclear, one of those big things. And then it's Euroclear or the DTCC which has the obligation to you. Now, what this means is that in a financial meltdown, when the DTCC or Euroclear or something similar is, if you like, in the middle of failing counterparties, they are perfectly entitled by law to take what you think is yours, shares in an ETF, and deploy it as collateral, or even dispose of them, bearing in mind that it's still got the obligation to you, because it'll just say, oh, don't worry, we've got an obligation to provide it, but meanwhile we're using them, thank you very much. Are you going to be like, do you like that? No, I don't think you would. So bear these things in mind. This is the difference between owning ETFs and actually owning the physical metal, either in your possession or in the possession of, or being stored in a vault, clearly your property, in a jurisdiction with strong property rights. Is that there was an explosion of borrowing, debt in other words, when interest rates were suppressed at the time of COVID. You had businesses who were forced to stop trading and needed to finance themselves so that they could resume trading once COVID was done. And as well as governments. I mean, you look at governments, the government debt in the US doubled between the end of 2019 and today. I mean, I think it was 23.6 trillion at the end of 2019, which was literally just before the COVID thing started, which I think was 23rd of March or something, 2020. And today we're looking at 47.4 trillion of government debt. So you've got all this debt, and it was all taken out when interest rates were suppressed, when the Fed was going in there doing QE and suppressing yields along the yield curve. So everyone's got all this unproductive debt, and it's basically turned a large portion of the US economy into zombies. And the US government itself, if it couldn't rely on printing money, as it were, is also a zombie. But so I really do think that there's a time factor here. The longer that we have current interest rates, even if they just stabilize them, the longer we have them stabilized, then what you're going to get is businesses falling over. And I think the car loans thing is a classic case, because that's just an agglomeration of debts, everything from good to doubtful to bad. And the idea is, it was the old syndication. Do you remember the property syndication business we had in 2006 to 2008? There are liar loans in there, but who cares? We can slice and dice this so that the top quality, which we'll sell off to the pension funds, will be AAA. It's the same arithmetic, if you like. You just get a huge great portfolio of all these car loans, and you can give them a rating which actually is far higher than it really deserves. Car loans. I think also the Main Street, as opposed to Wall Street, is not doing at all well. I mean, it really is not. So you're finding that people, they just cannot afford to pay these higher levels of interest, higher debt rates, and all the rest, higher interest rates. They're not, they're losing their jobs. They're not getting the pay rises, whatever. I mean, I don't care about job statistics. I mean, they're all wrong anyway. But you can see the underlying economy is actually deteriorating. And even though a lot of government statistics have been shut down because of, the debt ceiling, I really do think that, there are other indicators which show that the economy is just not good. And under those circumstances, you're going to see more failures. It's quite simple. Eventually, the big failure will be the US government. But that's reflected in a loss of purchasing power for the currency, which is why you have gold, and which is why when the Fed reduced interest rates a month or two ago, gold took off. And if they reduce it again, gold will take off again. And if they reduce it again, gold will take off again. I mean, because what's the Fed doing? Doesn't care about inflation too much anymore. The priority is to try and keep the economy going, keep the job numbers up.